Hi, my name is Sergey Savastuk. Today I'm going to talk about how to use inverse ETFs with AI trading agents. And at this particular moment, I just finished another presentation, which is called What to Expect from the Stock Markets After Liberation Day. So please watch this important video where you can get a lot of insights of what's going to happen. And where I covered the stock market uncertainty, internet bubble, AI bubble, what to expect in 2025, what are the leading indicators. And right now, on item number 8, where I'm going to present a case of trading versus investing. What's going to be important? The important thing is that out of this presentation, what I can say that the market is going to behave like that. That's important element. And there was some period of time for, let's say, 10 years when the market was like that and the expectation for the S&P 500 for investing were very, very low. And the question is how to deal with that. So now let's look at the data with this presentation. So I'm going to go back and I'm going to make a case trading versus investing. So if we look at the Goldman Sachs predictions, for exact that reason, as you can see, there were periods of times when, let's say, right after the burst of the internet bubble, the expectation of S&P 500 went down. So for almost 10 years, the expected returns were very low. And the Goldman Sachs predicts the next 10 years with a baseline of about 3%. So that means if you're going to expect similar returns, which were for the last couple of years, then you're going to be mistaken. So if you're going to be sitting in your 401k plans, just thinking everything is going to be taken care of by the market, and that's not going to be the case for at least this year, and for how many years, nobody knows. That means one needs to be participating more, okay? So it means you have to be trading more rather than investing. And that's where Tickeron comes and helps you. Let's look at this interesting chart, which is the household's asset allocations, okay? And the potential returns. So the blue line, that's where we are, which is the asset allocations. As you can see, at these days, there is only like about 35–40% allocated as a liquid assets. So that means if you don't have money to put into the market, then the market's supposed to go down. The yellow line is the returns for the current time. So that means if you look at the similar time when there was nothing to invest at the burst of the internet bubble, then the yellow line was here. So that means for the next 10 years, you see 83% correlation according to this chart. The markets were going down. So that means if the returns right now in the range of 15 to 10, about 10%, so then for the next 10 years, it's going to go down. Why? Because the liquid assets should go up, and only liquid assets are going to help to the market, stock market go up. Okay, so that means you have to learn how to trade, not to invest. And here's another interesting chart, also making a case of active trading versus investing. So here is the thing. The gray line, it is a return of S&P 500 buy and hold. Then, if we look at the reddish line, then it is a line when you missing, because you're not participating in the market, the best 10 days. Okay, so this is the best 10 days. And that's typically what presented these two charts to the investors, okay? So when these two charts presented to investors, then advisors are making a case that you better not be out of the market. You should not time the market, because if you time the market, you're going to perform worse. It is true if you really miss the best days, okay? But now let's look if you're active trader and you actively hedging your positions and you miss the worst 10 days. As you can see, the ratios of the blue line for missing the worst day is much better than even S&P 500, okay? So that means this is the case for active trading versus passive investing. And maybe not very lucky investing where you're missing the best days, okay? So that means if you passive investor, it's better to look at the strategy buy and hold and do nothing. But if you want to do something for the years when there is a lot of uncertainty and the market goes sideways, then you're going to be missing and skipping the worst days, then you're going to perform much better. Okay, so for that reason, we develop ticker-centric agents, which are designed to actually help you to hedge some of the positions you have. So that means if you like to trade Tesla, then hedge with short positions or inverse ETFs Tesla, okay? So let's look at the our website and see what one can do, okay? So that means we go here, AI robots, and let's look at the performance of the so-called ticker-centric agents. So you see, it is a TSMC, and it is, let me show you the main idea. The main idea is as follows, that if you have a QQQ as a NASDAQ ETF, and then you have QID, which is the inverse NASDAQ ETF. So that means when the market goes up, then the ETF goes down, and opposite. When the market goes down, the ETF goes up. So that's the basic idea of the inverse ETFs. And the difference between the inverse ETFs and the short in the market is that it is the opportunity to buy. So that means you don't need to be qualified for the margin account, so you still buy inverse ETF, and when the market goes down, then you buy and this ETF goes up. And that's kind of main idea. So let's look at the some of our TSMC, okay, TSM. So we're gonna look at the performance, okay. So let's look at the closed trades. So they're not bad at all. Let's look at the details of the statistic. As you can see, TSMC, it's a Taiwan semiconductor company. That's where we disclose all the strategies. As you can see, buy long TSM and buy long as a hedge SOXS, okay, which is the inverse ETF. And as you can see here, this is the last quarter. The green line, that's the performance of our bot, and yellow line, just buy and hold, TSMC, okay? So let's look at another one where we're just looking at the ticker-centric strategies, NVIDIA, okay? So NVIDIA, we look at this and see if we can outperform. Yeah, you see the same thing. You see the green line, which is the combination of the NVIDIA, and NVDS, which is ETF, which mimics short positions for NVIDIA. And that's exactly the same thing. Buy long NVIDIA, okay, and buy long as a hedge NVDS, which is going to hedge your worst days. And as you can see, we hedge that. And the machine, our AI, provides opportunities for hedging. And then it allows you to avoid the worst days. And that's the main premise of our presentation of these AI agents. So how you can find them? You go here, AI trading, and then you go to the list. You see it's a first generation, just signals. This is with money management. This is with brokerages. And then click here, ticker centric. And then you have different types of robots with different types of returns, and all of them giving you descriptions. And then you have small manuals how to use it. There's a lot of help, including customer support, and a lot of companies which performed really well during these market conditions which I just described. So go ahead and join our really big group of people which is enjoying the hedging with inverse ETFs with this ticker centric, and you're gonna really benefit out of the downturn markets. As you can see, Dow minus almost 4%, S&P down minus almost 5% for April 3rd. It is minus 5%, Russell minus 6.5%. Even gold went down on uncertainty, and that's what's going on. I hope you enjoyed these two presentations. Watch one first and then second, or in opposite, whatever you started. And then good luck with your trading, and think about the trade-offs between trading and investing. Thank you and goodbye.